Okay, here we are again. Connor continues to beat the market up 55% year to date. Jordy has started trading live. Interesting group of people, Tennessee, Texas, and London here from all different walks of life. So I know we wanted to follow up on last week that we were running kind of that 5-7 trade. So Connor put Jordy to work on a quite ridiculous timetable, and he put together basically this large back test of what is going on with this trade. And if you guys don't remember the trade, this is it's a 5-7 calendar. We're delta based, and we'll come back to that conclusion at the end. So looks like you spent a lot of time on this, Jordy. What did you kind of learn in regards to this?
Okay, so what my initial thought process was, because it has two sides, and I had done that with the power hour, the iron condor, I tried to find first the call side and then the put side. I'll separate those two. I'll try to optimize one side and I'll try to optimize the other side. But it was a mess. Like I couldn't really find anything that would, that would make the call side better substantially and the put side better substantially. So then I came to the conclusion that only isolating each side, because it was different lengths and maybe it was calendarized, it didn't make sense. So I had to say I didn't learn anything, which was very frustrating. But then I said, okay, let's try to optimize everything together, and let's try to move like stop losses and to move everything all at once with the four legs. And that's why I kept trying to find tendencies, but I just couldn't. So if you scroll down a little bit, I tried with different short deltas, long deltas, with different widths, not deltas, to see if it was, and I tried with different profit takes, with different stop losses, with different the put side, the this and that, and I was recording not only that, but the number of the max loss, the win rate, the PCR, to see if I would just find something that was, because sometimes it looked great, but the max loss was crazy, like 11K. If I have a 100 grand, I'm not going to risk on one trade 10% of my account. So
Yeah. And kind of when we look at this as like, this is kind of what I was fearful of. Like last week, we're like, oh, it looks good. And you can look at this back test and be like, phenomenal, we're going to get rich. But as we start to look at more of the data, we see that the sides individually lose money, especially on the call side. The side individually kind of loses money on the put side. And then also the fact that it doesn't work any other days of the week, and we have this particular setup. This is a just put in the pile. Like, despite how good this looks, this is too hard. We've just curve fit this to existence. And what I really want to point out here too is like calendar spreads are the ultimate curve fit trade, because what you do is you choose one time, and this is like the one time when the move did not happen. Like all the moves happened right before one or didn't happen after one. And then you choose the exact delta to where there's a bunch of, crazy volatility over the course of this trade, but it just so happened to like settle right at our profit take. So even though it doesn't look like we have a lot of filters, it's like we only chose one day of the week. We only chose one time. We use this particular duration. So like if this calendar was going to work, it'd have to be a 3-7, a 2-7, a 1-7. It'd have to work Monday, Tuesday, Wednesday, Thursday, Friday, and it'd have to work all up and down these profit targets. And Jordy did all this work, and some people would just say, forget about it. This works, and it's ultimately good. But we know this is like a real fallacy that it actually doesn't work. So in
but
my
Mark, hold on.
opinion, yeah.
So how do we know if this is a fallacy or not? Because based on this, I would run this. Listen, a 22% PCR, 7% KGAR, I mean, almost 8%, a little drawdown. And I'm thinking, why not, right? I mean, yes, I don't know where the line is between overfitting or seeing something that's real.
Yeah. So let's go ahead and take a look at this like before 2020. So like already red flags are like, it doesn't work on Monday, Tuesday, Wednesday, or Thursday. It doesn't work if we play it at like 10 a.m. It doesn't work if we trade each side individually, and it doesn't work before 2022.
Oh.
So like,
Yeah.
this is just picking one really particular slot And then also it's kind of a fragile trade. So like you could see, we got a $2,800 max loss, and it's like, what if we get more of those? So it's just the nature, like it's already red flag, like anything calendar spread, because we're choosing one time frame an entire week and we're only using XPS dailies data. So like there's only like if we go back in time or whatever, there's not that many trades that even happened over the course of this period. And then we've used particular profit takes and stop losses to try and manufacture this. Also, the fact that the wings are so tight and it's longer duration, like it's just skeptical that there's an edge. And what I want to do is I want to compare it to the trade me and Connor have done for a while, where it's like, I agree we can kind of curve fit with a Friday trade. So like here we are with it. This is our, Friday trade. It's been very robust. Obviously didn't work in 2018 very well, and it didn't work in 2025, or has not so far. But this thing has 30 wins in a row. You can see that if we go to do it every day of the week, the trade return does diminish. But we have our whole weekend effect in theory, why it works over time. So you can guys see it. We'll do it quicker here. So it's just something to note that there's always a trade-off when we're trading, and something that's less complex, that has less of max risk and is worked over a longer period of time without a particular time filter. Like we could run this at 3 p.m. We could run this at 10:30 and it'd still work on Friday. And you'll see here that I believe it still works okay during different days of the week also. So I guess now knowing that, does that make a little more sense why we feel more confident in choosing this trade over choosing this trade? Choosing this trade?
Yeah, I also realized that a big mistake that I was making is when I was separating the calls and the puts. When I do the all in at open, which is a bear call and a bull put, basically I do manage each side separately. But then I was putting stop loss on the whole thing, but I was considering stop loss and profit takes separately, but I would have put it together. So it didn't make any sense to separate the sites. And of course, I found out after hours and hours and thousands of back tests using poor options omegas, services. So uh, that I only found out after I had done hours of this, that it didn't make any sense because it behaved so differently together, even separately, that I was fooling myself.
Yeah. And that should be really the big red flag. And that's going to be the goal of back testing, where people will sometimes just continually back test until they see a result they want. But it's like you were able to realize that if it doesn't work separately and it works together, like something's a little fishy, because why would you trade a condor if the put and the call didn't make money, but together they made money for some reason? You know what I'm saying? It's a little fishy. And then also the fact that we have one time on one day of the week with one particular set of profit targets is just kind of not great. And then you can kind of see here, again, this trade isn't meant to like print money. You can see it does make money outside of Fridays. But the key thing about this trade that I kind of like is, again, this is not a driver of our profits, but the fact that, trading one contract, which we use $5,000 of buying power over the course of this period, we 3 extra money on the buying power. So this is literally something that like your options portfolio has additional capital that you'd like an undiversified trade to, and go ahead and use 3 to 5% of your buying power to make 3 to 5% with a 3 to 5% drawdown. Like that's just kind of how I view this trade. This isn't going to drive our returns. It's just something we can run. And then it's nice trading options where our max risk is only, it's not even $5,000, because if these are so close at the market gaps, we're not going to get hit on that at all. Does that make sense? Or you guys have any more questions on that?
Yeah, I kind of had a question to dive in. That does make sense. So, like, the overall theme of it is the issue with the first trade was it's almost like curve fit, and we don't think it's going to actually work in the market because
Well, here's the
it's
question.
so
Why is it
focused on.
curve fit, and what did you realize? Like, how did you realize
It's
it was
curve
curve
fit because when you're running through the back test, like it only works on those two parameters. It's not like, it has this trending mark where, oh, if we move the delta down just a little bit much, it just loses a little bit. But if we made any changes to it, the trade was dropping off and not performing well on the period of time. And rather, when me and you have worked on a lot of trades, Mark, that when I'm back testing them, we can find which one is the best one, but you can follow the trend of it as well. Like you start seeing the trend, like, hey, you come to a conclusion of it basically.
Yeah. And kind of what a trend would look like is we talked about this last time where there's like a curve and then there's an inflection point where it flattens out. So like what we should have seen is like the call side made money and then like maybe starting at a 10% profit take and 100% return, it made money all the way to a 50% profit take and a 500% return. And if it did that on both sides and they looked good, and then when we combined it, it looked better, then that would be okay. And the other thing too is it's like I would be okay with only running this on Friday because again, this is a trade that's capital efficient. We're only trying to make 3 or 5% of our portfolio. So like if everything else was in line, we would potentially be okay with only a day of the week. But the fact that it wasn't in line and all the other days of the week nuked it even more, we know that that was just made out of thin air. Whereas that 5 delta 7 DTE trade, it's potentially a little better. And kind of going back to the topic of back testing and learning, I know Jordy found another trade that he brought to us. So Jordy, I know you said you took out a personal loan, you're going to Fort Knox, you're leveraging your account to make millions of dollars off of this. Connor, do you want to kind of give us your opinion on what you see here with Jordy's afternoon 1 day to expiration trade?
Yeah, so we kind of talked about this earlier in the Discord this week, and Jordy was saying he was just gonna dump all his money into it and get rich, and it's pretty funny. But looking first into it, the slippages are a little bit off. We'd like to be on the exit slippage around like 0.2 on the exit, so there's a little bit money missing there, and the stop loss slippage.
Like what I want to point out here too, Connor, is I actually think so. This is part of trading. I actually think it should be closer to $1. So like you can see that our average credit is $70, $80 when volatility is high, 190. So like it's going to cost us at least $1 to get out of this, and I'll kind of add that into the trade. But yeah, keep going, Connor.
Yeah, so basically just coming from the slippages, when you start seeing the slippages that are off, the trade might actually not perform as good as you think it is when you put it into the market. And then going from there as well, he has intra-minute on there. And since it's 1 DT, there's no intra-minute on there. So it's kind of just like a false filter that's not really actually doing anything. So it's kind of giving you that thought process of like, oh, I have intra-minute stop on this, I have extra protection on it, but you might not actually have that. You actually don't have that. So when you're going live into the market, you might see more losses than you actually thought. Those are just my initial thoughts right off the bat. There might just be some money that it looks really good, but there might be more money on the table that we're losing than we actually think when we put this thing live.
Yeah. The other thing too is like you forgot to exit Jordy. So you're taking this overnight. So we need to, I'll show you how that setting works, but we would basically use early exit.
But yeah, at 0 days in trade, I was saying.
Yeah. So.
Oh, okay. Well, you do it different. Yeah, I was putting 0 days in trade. I don't know why you didn't record that, but yes.
That doesn't look good. And then also like this is technically naked, which is fine to test, but we need to bring in the wing cost on entry. So I think 15 cents to enter the naked option is decent slippage, but I think we should put in 50 cents in general. Let's say we're paying 15 cents for a put wing and 10 cents for a call wing. So that's already kind of like a lot of problems with this, but this was a good test to kind of bring up. So you can see here, it takes the return down more now that we added the stop loss slippage. And then you'll see when we early exit, it actually may improve it slightly, but the slippage, I think, will kill it. So I like that you brought this and did this, Jordy, because I think this is a good background to like try new test. It's like, we don't have a lot of variables because we excluded the wings, but we want to make sure next time we include the wing cost on the entry slippage. We want to kind of double check that, I think this one's closer to probably 1% for exit slippage just because there's not as much gamma at 1 DT, but we'd want to check our slippage. And then we learned some new settings with the early exit here, and we can make better assumptions with the win cost and everything. So I think that was good. I don't like that trade because the whole key behind it is options tend to decay into expiration. So the
So
closer
you
we
don't
are
want to
to
be a millionaire?
I don't think that's the trade. So like, this is good that we're innovating and we're trying, but like now we kind of got to put our foot down on like, we have 100 grand portfolios and we're trying to add trades to it. So we want to be more
That's what that
judicious.
was going to be my next question.
Yeah.
Like I want now I'm running the all in it open, so the iron condor based on VIX, or the reverse iron condor also based on VIX, so it's either or, and then the power hour. They've been performing very, very well. And even, yesterday, you killed it. I killed it too. Like my bot and Connor killed it too. So it was the perfect
Connor did
market condition.
5.5% yesterday, dude.
I
He's
know.
beating all
But
of us.
yeah. But now I feel I'm ready to open like a new trade, and I don't know what trade to do. Like I don't know how to decide how I don't even know where to look, because I would just keep opening more contracts of what I'm doing because it's working so well, and I know that's not correct because I'm just increasing risk and I'm not increasing like diversity. But I don't know how to diversify within what I have already. Where should I look at?
Yeah, I mean, I would say in general, like first step is we want to get to 4 to 6 trades before we just do more of what we're already doing well.
Yeah.
However, in regards to that, success leaves clues. So like I definitely try to get your emotions being patient and curious more than like, how do I make more money faster? But I would kind of say that if you could describe in your all-net open and your power hour, or reverse iron condor, what has been working and why, we could use that as a hint. So like, I mean, both of you guys trade the same thing. So if you guys have any thoughts on like why those work, and then maybe I could give you guys some ideas of what I think we could look at next.
Why it has been working in terms of what? Like, what do you mean why?
So I
Because
think there could be a few ways. It's like when we are automated, obviously we don't want to mess with it, but it's good to look at the trade and be curious. So it's like we can look at what happened in the market that prior day. Did volatility go up or down? We can look into the back test more, like exporting it to Excel and be like, what environment does this work in? So it's partly noticing like what the overall stock market has been doing and how that relates to you making money. And then also like you could look into the back test from the past and be like, how many points did this move? What did it work in with a VIX? Because like you're doing those really detailed back tests that are great, but we're always going to be revisiting those really detailed back tests with different parameters once we see it in real life, because that's going to spark our idea to be more curious. So like kind of knowing that, what have you guys seen or experienced from that?
I've seen when I'm watching the trend of the market lately, and when our account does good, Mark, it's when the ball falls at the end of the day. When we have
when there's
when
not
we
a big movement at the end of the day.
we do well there, but there's so much movement in the middle of the day, and that's where I'm like, I can see we can start to try to diversify by, maybe diversifying more in the morning, or even in the middle of the day. But my question is, it's just like, it doesn't look like that's a place where I'd want to put a trade in right now, to be honest with you. So do you just hold on until the market starts to shift and be patient like you're talking about, or do you start playing with it at all?
So I think we should test it. So we know Jordy's trade from 1 to 2 has been doing well. And the thing is, it's like, even though that midday has sucked, if we take Jordy's trade and say, hey, if we add 12:30, noon, 11:30, 11, how does that look in the past, even though it has not done well of late? Because if it's good in the past, we know it's going to come into favor. And then also, like, even if it doesn't beat just doing twice as much between 1 and 2, it's most likely going to make a nicer portfolio over time. Whereas like we may not make as much money, but we may only spend 6 weeks in a drawdown instead of 10, which is kind of valuable to me, because to keep us going, I'd like to make consistent money.
Hold on, but what trade? I mean, we're looking at more iron condors,
Yeah, just your simple iron coppers. Like you have your $2 and 250 with a 4x stop.
I think I'm doing 225 or something. Yeah, something like that. Yeah.
So we could be like, let's go to 12:30 till 11, and then let's see if those same mechanics work, or a 1.5x stop works. Or we could say, let's do 10, 10:30, 10:45, 11, because that'd be more towards the all limited open. And then that would also be nice with the all limited open, because we're trading something every day. So if the market moves or doesn't move, that could be a nice change in it. So this is how we're using the same mechanics, but we're diversifying kind of through time. Or we could change the mechanics. We could collect more premium, we could collect less, we could lower the stop, or we could raise the stop. And this is just a thought, but instead of just blindly adding one contract to two contracts, we've got 4 hours a day, we're not doing anything.
My question is going to be, do you go back and deep dive into the data of when, like, so let's say we start testing the 12 and the 12:30, and we kind of start understanding when does this work good in the market? Do you find a good back test, find one that has edge, find one that has performed well since 2016 or however long we want to push it back? And do you wait until the market starts shifting towards those conditions before you launching it, or do you launch it now and just go from there?
I mean, I would love to, but I have no idea when the conditions are going to change. You know what I'm saying? So in general, my kind of thought with it is, as volatility increases, it's generally shown once the market opens, and then it's bid up by the time it's the end of day. So I think the saying is like, buy the whatever, sell the news. So I think that as volatility comes down, and I've seen this in the last 2 days because I've been looking obviously at the market, I've seen that there's been a little more volatility towards the end of the day because there's been no news and volatility's been coming down. That's just a theory, but as long as it looks good in the past, like, we are golden. And another thing I do to test too is, a lot of people only look at 2025 or something to be like, what works in this market? But I'll actually only go to the end of 2024. It's called like out of sample data. And I'll just test whatever has worked before that, because it basically prevents me from having any recency bias. And by not having it on the screen, it doesn't like feed my dopamine rush of like trying to beat the market in some new condition we're unaware of. Because whatever has worked in the past is our best assumption of what will potentially work in the future. And then we'd run it live small and see how it goes.
I love that.
So you're saying that...
Go ahead.
So you're saying that you're going to enter a trade now knowing it's going to perform poorly, hoping that it's going to reverse and perform well soon enough?
No, I'm saying that we're going to test a trade up until the end of 2024 and exclude what's happened in this Trump market. And if it has performed well from, let's say, 2020 to the end of 2024, I don't care what has happened in 2025, because we're excluding the recency bias. So we're doing the opposite of what a lot of people try to do, where it's like, what's worked with this market, and then they chase their tail. Because in my opinion, volatility is always priced the same. Obviously, we're in kind of a different regime, but it takes time for volatility to get repriced in, and we really have no idea how long that will take.
So basically, your thought process is like, I'm buying S&P 500. You know that it's down right now, but
it's like an index fund. Yeah,
it
like
goes up.
If risk assets go out of favor, oil will go into it. And like, another way to think of it, it's like, regardless of your political views, it's like Donald Trump's been saying some stupid shit that probably wasn't that well thought out. And it's like, I think we're kind of at a point to where he has to say even stupider shit for the volatility to keep expanding, which like, I think it's within the realm of possibility, but like, he's setting a new standard for how dumb of shit he has to say with like not communicating to whatever in the market. And this is just funny, but the example I like to give is, they were talking about like getting rid of Jerome Pal. And then it's like, how they determine interest rates is like, every single Fed governor, I believe there's 12 of them, has one vote. So like, Jerome Powell's one vote. So like, if they were to get rid of Jerome Powell, the 11 other people are still in there that would have to vote on it. So I don't know if that would really materially change interest rates. Granted, like, the chairman of the Fed probably has sway over the other Fed governors, but like, that's just an example of like, well, that's not how it actually works. Like he's one of 12 votes or whatever it is. So you would increase your percentage by like 7% if you put in your puppet governor. And then also like this, I believe it's the Senate has to swear in like the new chairman of the Fed. So like even if he did try to appoint someone and impeach him, the Senate would have the right over it with like a supermajority. Whatever. Not a thing, but like this is just an example where it's like this is now what is priced in, and like we're on the up. So now that we've got to this higher volatility level, it's like if it doesn't get crazier, it's kind of going to naturally come down. And we've seen a little bit of that this week. Like the S-Fall trade came in and mine and Connor's portfolio, we bought some up. I think Jordy's almost there. He bought a little later than us, but it's basically come in. So do you guys have any other questions? I think that was kind of a good place to go. We'll look at those trades at different times. Anything else?
So just test more iron condors, different parameters, excluding 2025. Whatever worked in the past, that's
and
it,
before
right?
1
Different
p.m.
time, different time.
And before 1 p.m.
Yeah, different because we're doing, and you wouldn't add a 1 p.m. because I'm doing 2 p.m. So you wouldn't double down on 1 p.m. because it would be doubling down, right?
Yep. We will get to doubling down. Like we're obviously making a series, but like when we get to 4 or 6 trades, it's kind of eventually it's just going to be like just mash the profitability button. It's like what's worked for the last 3 months.
But the thing that sounds counterintuitive to me is that we do more iron condors. Why not straddles, whatever, short, long? Why more iron condors? That wouldn't that make sense to change a bit things? Because it's the same parameter. We want volatility to contract, same neutral strategy.
Yeah. No? So the reason I like condos more is like, so the at the money volatility is the most accurately priced. Let's say it's 15. And then when you're out of the money, it gets bid up from skew. So like, regardless of the volatility environment, like the condor's going to be at like a 20 VIX, one the at the money or straddle is going to be like a 15 VIX. So with the at the money straddle, you're playing much more of I actually think volatility is going to get crushed like it did yesterday when we basically didn't move all day. Whereas like if you're just blindlessly selling it every day, that's just going to be a little more consistent spot to make money. And like the risk to reward is a little more muted. Like you're taking less risk and you get less reward. Whereas at the money, you're taking a lot more risk for potentially a lot more reward. You can do it. I imagine like over the long term, since you're collecting more premium, this is a concept of like premium pool. So like the more premium you collect, the less PCR you need. Versus a condor, it's like you're collecting less premium, but you need to make more of it. So it just makes it harder to spread it out through time of day and all of that. So psychologically, I just prefer not to do it. But if you want to test it, you can. It's just going to be harder.
I was just conceptually. So you're gonna go again for a higher win rate and lower PCR because we're doing condors again, right? And that's basically what we're gonna.
It should be a higher win rate and a higher PCR, but we collect significantly less premium, so the money we make may be a little bit muted. So
okay, yeah. Sorry,
like think about there's 3 concepts. There's like how much premium we collect, which could also be called capital efficiency. So like we could trade a much tighter spread and collect much more premium, but it's going to make less PCR, which is like how efficient we are at making premium. So like if we look at this, it's like Donald Trump released the most tariffs ever, massive tariff pool. PCR was terrible because they didn't think about it at all. You know what I'm saying? And then we have a risk to reward, which because the PCR is terrible and they threw out a bunch, the risk to reward probably isn't that good. But if we really thought out what we were doing and we only targeted, one thing, it could probably help. You know what I'm saying? Like another example I give is like children are good for the economy. Parents work harder and parents spend a bunch of money on their children. So like tax cuts on people that have kids is probably good for the economy more than tax cuts for Facebook or whatever that maybe is for the economy. You know what I'm saying? So not like to get any political, but these are just examples of we need to, and like you're starting to get there. Like the way I describe it is you're unconsciously incompetent. You have no idea what you're doing and you're completely unaware of it. Then you're consciously incompetent. You're like aware that you don't know anything. And then you're consciously competent. And I think we're in between consciously incompetent and consciously competent. And like once we get there, we can actually start to move forward. I just don't want to move too many steps ahead and make sure we get all this. Like I saw your back test. Like Jordy sent this to me in Discord, and like within 15 seconds, I had like 8 things, and I was like, nope, sorry, it doesn't work. That's like unconsciously competent. Whereas like you went 2 or 3 hours doing that, and you had a conscious, you were consciously incompetent. Like you didn't even really realize what you were doing that was wrong until we started like looking at it, and then you got to conscious incompetence. You're like, oh, I did not know what I was doing. So basically that's the emotional pattern I'm looking for you guys in trading, is that you start to realize your mistakes, and then we can move toward conscious competence, and then boom, we're off to the rocket ship. Like, let's just throw the leverage on. You know what I'm saying? Because you don't want to make that step forward, and then you need to lose a bunch of money and feel emotional and be like, what is wrong with this? Like, let's solve that problem before we get there, instead of just rushing into it and then getting that feedback what's going to be wrong. Obviously, a lot of people don't like have the luxury of bouncing off of people, but this is probably the biggest takeaway from the whole call. And I want to focus on that emotional aspect of it more than just testing. And like Jordy's really detailed. He's like very like trending towards conscious incompetence. I think he's already kind of there, but he really wants to get to conscious competence, because then we can go back into and do it. And these patterns would be conscious competence. Like, what is happening in the market? What do we think we could improve the portfolio?
Okay. It just sounds, I mean, when you talk about in some of your videos, and I've heard you before talking about why you do one trade, this is a long ball. I mean, you use so many fancy words, and now you're just saying, well, do more iron condors and see what works. I'm going like, what?
Simple.
Like, yeah, exactly. Just almost too simple, right? I was expecting something more complicated and more okay. Makes sense. Makes sense.
And like the hierarchy of how we do stuff is like, we're always going to do 10 times more of what we already know how to do and what is working before we ever do something better. That would be the next step. And then we would do 100 times more of already doing what's working, more of it, before we ever do something new. And that should basically be the ratio of our activities until it gets so simple. Again, Karate Kid, like wax on, like, why am I working on your damn fence? It's like, well, you need the rep,
Yeah, I don't mind putting in the hours. 3 hours, it took me way, way longer to do that. Only 3 hours, I wish. But I was just like, because I get into this backtesting narrow view that I have to just improve Kager, and just keep backtesting. And now I'm going to do 1 p.m., 2 p.m., 3 p.m., then 1:30. Oh my God, 1:45, 1:40, 1:55. And all of a sudden I've done like 200 tests, but what's the most optimal time to enter at increments of 5, because I see, well, I'm not going to do minute by minute, but I could get to minute by minute if I'm not careful, So, yeah.
And then also we've got Jordy coming out to Austin for another boot camp in 2 weeks. So if you guys want him to do anything, please drop it in the comments. And then before we leave, I've got a treat for everyone. I've got charged full moon crystals here. We get to each choose one. We have Tiger's Eye, which is good for fear and anxiety. Then we have clear quartz, which is a stable high frequency magnetic field. And then we have pyrite, which is the money magnet stone. Do you guys have a choice of which stones you guys would like?
Jordy, are you going for the money magnet?
Yeah.
Well, I'm going to go for the money, because my return is still the lowest, and I meditate every day, so anxiety is taken care of.
So Jordy, you'll get the pyrite, which is the money magnet, and then Connor, do you want the high frequency or the fear and anxiety stone of Tiger's Blood or clear quartz?
So does the fear and anxiety get rid of fear and anxiety?
Yeah, it's supposed to balance you out.
Because I don't want that on my life, man. If it's given me, I'll take the fear and anxiety one.
Okay, Connor's going with Tiger's Eye. So, and I'll get a stable, high frequency magnetic field that aids in meditation and a higher self.
Wow.
Remember your stones, and we'll check in with you guys next week. But another great week of teaching everyone.
I love it. Thank you, Mark.